So we'll open the meeting here. Representative Barrett, Carter Barrett, how are you, sir? We're glad to have you today. Representative Barrett, if it would be the pleasure of this committee, if you would allow us to appoint a subcommittee on your bill and work with you over the summer to get this bill perfected. This bill's got a lot of good parts in there, and I'd like to appoint a subcommittee if that sounds good to you, and we'll move your bill that way. Let me see, you're on number 2?
Yes,
if you're on number 2, if anything you want to say to us while appointing a subcommittee, anything?
No, I'm just delighted at that idea. It's a great idea, and given these unusual circumstances in the economy and banking today, I just can't. The timeliness is
Absolutely.
perfect. So thank you for
Absolutely. I really appreciate you working with us, and we're trying to obviously, come to a great bill. I'll appoint Senator John F. Kennedy as the chairman of the subcommittee, Senator Sonia Halpern, and Senator Mike Hodges. If you two will serve on the committee and get this thing done here, and hopefully we'll bring something back to us, and we'll be able to have us a good bill.
Very good, sir. Perfect.
Please stay with us, because we're fixing to have something very enlightening here from our resident person who knows about banks. Mr. Bo Fears is going to come talk to us about the state of banks in Georgia.
I can't think of a more interesting topic.
Thank you, Representative. Thank you so much.
Thank you, gentlemen.
Thank you. Come on up, Mr. Fears. Hey, Tanya, how you doing? Thank you. Thank you. Thank you. Mr. Fears, it is wonderful to see your smiling face here today. Thank you for making changes in your schedule to accommodate us. I apologize about us getting pushed back, and I apologize about always getting, seems like our schedules get kind of cramped up together. But I think it's extremely apparent that we hear from folks that knows about the banks, understands about the bank conditions, what's going on in the United States today in some areas, and tell us how strong our banks are in Georgia. And if you don't mind, I'll turn the floor over to you, sir.
Well, thank you, Mr. Chairman. I appreciate the invitation and the opportunity to address this committee and talk about the state of banking in Georgia. In light of the recent failures of Silicon Valley Bank in California and Signature Bank in New York, I think there is fear and uncertainty in the market. And that's really understandable when you see what's playing out, how it's being presented in the national press, and also what I would probably term as dangerous speculation on social media. However, notwithstanding how it's being portrayed in certain circles, the state of banking overall in this country is very strong, and that's especially the case in the state of Georgia. The department, for those of you who are unaware, we have two primary business lines, and the first is the non-depository area, where we regulate money service businesses, which include money transmitters and check cashers. We regulate mortgage lenders and mortgage brokers, and we regulate small dollar lenders. The other side of our business is the supervision side, and we regulate banks and credit unions. And so part of that regulatory oversight involves routine regulatory examinations where we go in, us and our federal partners, and we look at the condition of our banks and credit unions. And the examination, what we do, it's called there's a CAMELS rating that comes out, and that stands for, we're looking at the institution's capital, we're evaluating their assets, we're evaluating management, we're evaluating earnings, and as relates to kind of what specifically is happening right now, we look at liquidity, and we look at sensitivity to market risk, so we look at interest rate risk. And we do that with our federal partners. And then when we're not conducting examination, though, we're getting routine reports from our banks, and we're making sure that there's no outliers or there's no issues in those reports. And if we see anything that causes any concerns, we reach out to our institutions and we work with them until we feel that we understand the reason for that outlier, and we do that until we're satisfied. So that's kind of the general overview of what we do. Specifically as it relates to Silicon Valley Bank and Signature Bank, because they are chartered in New York and California, they're not chartered by us. I do not have any special insight on those institutions. I do, I'm able to look at what is publicly available and look at that data. And so I'm able to determine, and the department has been able to determine certain characteristics that are present at those institutions or were present at those institutions that are not present. Those characteristics are not present in our state chartered institutions. And I'll just try to identify a couple of those for the committee. But first, before I do that, I do want to emphasize a very important point, is that deposits are insured by the federal government. The FDIC insures deposits, and a penny of insured deposits has never been lost in this country's history. And so the deposit amount, typically people will reference there's a $250,000 deposit amount, FDIC insurance, but your bank relationship and the FDIC, that relationship can be structured so that you get greater coverage than the $250,000. Signature and Silicon Valley Bank, it's important to recognize that they had a number of uninsured deposits. I think the Signature Bank was roughly 90% was uninsured, according to public reporting. Silicon Valley Bank was higher than that, and that's that's a high number. But the federal government, even though those were uninsured deposits, the federal government, the FDIC, the Treasury, the Federal Reserve, and President Biden determined that these banks posed a systemic risk. And so all the deposits, whether are insured or uninsured, were covered for the depositors of those two institutions. So going and looking at the characteristics of these institutions. The first is both of these banks focused on providing services to technology type companies, so fintechs or and venture capitalists who supported those fintechs, or cryptocurrency companies, and they had a concentration in that area. It's important to remember, within the last year or so, those companies have struggled economically, and so there've been a number of layoffs at fintech companies. In the crypto space, a number of those entities have filed bankruptcy. In Georgia, we don't have that concentration, right? We're much more diversified. I am unaware of any Georgia state chartered bank that even banks a crypto company. So we do not have that concentration. A second distinguishing factor is the level of uninsured deposits. As I indicated, those uninsured deposits, according to some publications, were 90% or more. There's no Georgia state chartered bank that even comes close to approaching that number. And so, because of that, those deposits have a tendency to be volatile, especially if there's any loss in confidence in the institution. So, what happened with, or what appears to have happened with Silicon Valley Bank, is that information was disseminated via social media. The depositors lost confidence in there, and they withdrew their funds, fearing that they would lose access to the funds and the uninsured deposits, and that the bank would fail. And what happened, though, is that was a self-fulfilling prophecy, because they withdrew the funds and they failed, even though that bank had assets far in excess of its deposit liabilities. So it was technically solvent by $40 billion, but it was illiquid. So that caused that failure. And the final piece was the security portfolios of these institutions. And so what has happened during the pandemic? A number of banks, they were flush with deposits coming into their bank. But there wasn't a lot of loans to be made, because all these PPP loans were made to these institutions, and so they were flush with capital and they were forgivable. So there's no reason to borrow from a bank, because you already have this money. And the banks needed somehow to deploy it, so they put a lot of those funds into securities. And when the interest rates were relatively flat, that was fine. But within the last year, when there have been the interest rate raises, that's created unrealized losses. So essentially paper losses in the bond portfolio, right? And so with Silicon Valley Bank, I think that On Wednesday, so 2 days before it failed, it announced that it had liquidated a portion of its securities portfolio, roughly $20 billion, and it had to realize a loss of $1.8 billion. And that was made publicly available, and that's what fueled the crisis, or fueled the run. I think it's worth noting that currently most banks have unrealized losses in their securities portfolio, but that's very important because it's unrealized losses, right? That they're not recognized, and they're still worth the same thing when they actually redeem them. And our banks have done a very good job of accounting for that interest rate risk by hedges or other mechanisms, so they do not have that same exposure. But I think what's very important to emphasize is because the Fed recently the Federal Reserve, issued a liquidity facility in light of these recent failures. And it's the Bank Term Funding Program. And what it does is if a bank pledges its securities, these securities as collateral, the facility will provide funding and the face amount or the par value of the securities as opposed to market. So if the security is, say, $1,000, they'll get $1,000 back instead of the haircut at $900. And so what that means is if this facility had been in place 2 weeks ago, Silicon Valley Bank would not have had that significant loss of $1.8 billion. And I hypothesize that neither one of these banks would have failed. And so they would have been around for years if that had happened. So based on those three characteristics, we don't have those in our Georgia state chartered banks. And so I'm very confident in the safety and the strength of the banking system in the state of Georgia.
With the parameters you all have in place, is my understanding, you could almost foresee a bank that's not working or getting their job done before it would fail. You'd be able to know in Georgia because we have these parameters in place.
Yeah, so I think there's, if you look at Georgia, like if you look at our history, right, during the Great Recession, we had a number of banks that failed, right? But none of those were liquidity failures. Those were all capital failures.
Capital.
And so you have an incredibly long runway, for lack of a better word. Under federal law, it's prompt corrective action. Once a bank drops below 2% Tier 1 common equity capital, the FDIC has to take possession within 90 days unless that institution is able to raise its capital. So because of that, if you go step back to the Great Recession, even though we had a number of state chartered banks fail, the FDIC was able to find acquirers. It was called whole bank purchase, right? And so both the insured and the uninsured deposits were acquired. We had a handful of banks, I think it might have been 3, where the uninsured deposits were not acquired. But because we had that long runway, bankers would work with their customers to structure their deposits so that very, very few Georgia customers, 10 approximately, and out of 81 banks failing, lost any funds. So to that extent, we do. With a liquidity failure, that's, at least if you look at Silicon Valley Bank, right, and you look at Silicon Valley Bank, it's social media fuel, right? So this is something that we didn't see during the Great Recession. This is something that is very different. I think another thing that's important, so it's that social media driven. And so that creates some concern about how that necessarily plays out.
The run on the bank.
The run on the banks,
Right.
for example.
Yeah.
And so part of it, because it is social media fueled, and it's also the change in banking, like mobile banking.
Right.
So, if you look at it, It's a Wonderful Life, everyone wants to kind of run the bank. They talk to their banker discourages them, right? Explains how safe the institution is, how you can structure deposits. Well, that doesn't happen now. So in Silicon Valley Bank, I believe there was an effort to withdraw $42 billion in one day, which is pretty significant if you're $160 billion in deposits. So that's kind of hard to anticipate that. But, there are, again, if you have access to liquidity, and I think the Federal Reserve's liquidity facility that I just mentioned, right, where you can get your securities at par value, as well as other, FHLB lines, the Federal Reserve discount window, when you have access to that, there is adequate liquidity in the system.
Well, the concern was that, people, 2007, 2008, when we had the big issue with, the meltdown, whatever you want to call it, back in those days, where people went underwater and banks, obviously, we lost some banks in town. It's an entirely different situation than we're facing today. I mean, it's not the same animal as the real estate being underwater, which created all this landslide effect.
Yes. Well, and I think that, and I do agree that it's different, but I think the reality is you're looking at massive uninsured deposits of these institutions, right, which we do not see. You're looking at having to recognize losses in the securities portfolio, which we would not have to do now, and because of A, steps that have been taken by the banks, but B, the Federal Reserve's liquidity facility, and C, you've got massive concentrations in an industry that is having significant economic issues right now, and we do not have that. We don't see that concentration. So it's very different.
Well, I think it's extremely important that people of Georgia realize that the Georgia Banking Commission in Georgia, the politicians in Georgia, Georgia State, the whole people, we support the banks. Our banks are in great shape, and I wanted people to hear that. I wanted people to know it. And I got any questions from the committee. You might want to ask some questions. I want you all to know. Excuse me. 10.
Thank you, Commissioner, for giving us that report on Georgia banks that are chartered. What about those big banks operating in Georgia that are not Georgia chartered banks? For example, Truist as an example, that's a North Carolina chartered bank.
Yeah. So, again, I don't have any unique insight into those banks. We do not regulate them. The state of North Carolina regulates them, or say Bank of America, they're regulated by the OCC. Those institutions overall, I think that they're equally strong because they do not have those concentrations. They wouldn't have to realize those losses. What I would say is that we have been in daily contact, sometimes multiple times, with regulators both at the state level and at the federal level, discussing the banking environment in this country and what they're seeing and concerns they're seeing. And I can say overall in this country that regulators are not that concerned about what they're currently seeing in the institutions. It's especially true in the Southeast. As it relates really to the bigger banks, the report that we are hearing is that there, on the whole, that there are net inflows of cash instead of outflows of cash. So I think what's happening is you're seeing customers of Silicon Valley Bank and Signature and maybe other banks that are maybe fintech focused or crypto focused. They're taking their funds and they're moving it into what they view as safer banks, more diversified banks.
Thank you.
Yep.
Number 8, Senator Hodges.
Thank you, Commissioner Fair. The instance that you were talking about earlier, during COVID, there was a lot of money put into the bank system, a lot of federal money. Almost all the banks were flush. And you were right, loan demand was terrible because of the PPP loans. So there was a lot of investing, an awful lot of investing. Most banks, I know some banks didn't, some banks stayed short, proved to be smart, but a lot of banks bought treasuries, bought agencies, and with rates going up, I mean, you can see the issue when there's a liquidity, not liquidity run or a liquidity demand, and you have to sell some securities that are that you have a loss in, and which is what happened with Silicon Valley. My question to you is, the banks in Georgia, that what is the availability of that Federal Reserve liquidity facility to the banks in Georgia that most of the banks that you regulate? I'm sure there's some non-member banks. They're non-holding company type situations. So is everybody, can any bank?
Every bank.
Every bank in the
in
United States can get into that facility, and they just basically, if they've got, like you said, $1,000 bond, and it's because it's at a higher interest rate or a lower interest rate, it's now worth $800. You can get $100. You can get $1,000.
You get $1,000. Yes.
Okay, great.
Yeah.
That's wonderful.
It is a wonderful facility.
And also, I'll ask you to mention again how you're working with other regulators. You're working with the FDIC. You're talking, because again, there aren't just small banks in the state. There's some large banks.
Correct. Yes. So we're working with the FDIC, the Federal Reserve, the Office of the Comptroller of the Currency. We have daily calls with, it's hard to say that it's every state regulator, but every state regulator is invited. And, we're just discussing trends that we're seeing, outflows, inflows of deposits, and facilities, what we can, we're having conversations about potential acquirers for institutions. So it's a very far-reaching discussion.
One last question. Do you happen to know the percentage of uninsured deposits in Georgia?
I think that that's a tricky question. And the reason I say it's a tricky question is, when you pick up uninsured deposits. So if I have $251,000, right? That's, even though only 1,000 is uninsured, it's going to pick up as, and the entire amount's $251,000. I think also, if the call report, as you know, is incredibly detailed information, and it goes into liquidity and it pours into that. But it does not necessarily capture everything. And I think, as the commissioner has frequently said, is liquidity is more an art, right, than a science. Right. And so, for example, we look at the data, we'll see what's reported as the uninsured amounts, and then we'll reach out to our institutions, and we'll find out, let's say that it shows that they have 30% uninsured deposits. Well, we reach out to them and we determine, 10% or 15% is collateralized because they're public funds and they're fully collateralized. So we've got to pull those out. Or that they use IntraFi or CDARS, which are programs where you can take the deposits and send them to other banks so that you get fully insured. And so it's hard to quantify, but it nowhere approaches 90%.
Okay. Mr. Chairman, just one final comment is that in almost 50 years in the banking business, I've been through a number of really, really scary times, and I think the recession, 2009-10, was probably the scariest time. I commend the state regulators and federal regulators for putting our banks on a path to not be in that position again, to have better capital, to have better reserves, to watch our liquidity. And I appreciate, as a banker and as a bank customer and a bank shareholder and a regulator and a legislator, the good job that you guys have done. Thank you so much.
Thank you.
Mr. Pierce, thank you. That was the state of the states of banks, we'll call it, in Georgia.
There you go.
We needed that. It was good to hear. It's refreshing to know that folks like you are watching over us and make sure they're dotting I's and crossing T's.
Thank you.
That's what matters. I'd like to take this moment to thank the committee for our year this year. This will probably be our last meeting, unless something comes up that I don't know about in our time frame. Wednesday night is our committee dinner supper night, Pure Taqueria. Please know that that's at 6 p.m. Is that right? 6 p.m. I want to thank Miss Emily and Miss Sarah. They make everything happen in our office. You can't ask for any better, finer people than these two girls right here. and whatever happens to them, I hope they come back with us next year. I really do. I'd like to recognize our state treasurer, Steve McCoy. Steve, it's been exciting working with you. I've learned a lot from you. I can tell you right now, you confuse me every time you tell me something, so I just want you to know that up front. But I really appreciate your knowledge and your intelligence on that level. But thank you kindly, sir, and that. And last but not least, it's been fun chairing the banking committee. I met a lot of friends. I've learned a lot of new things, and I hope that we continue next year, and hope we're as positive this time next year as we are again. And once again, thank you for rearranging your schedule to come and speak with us, Mr. Fears. It was very kind of you.
Well, thank you very much, and I appreciate the opportunity.
Meeting adjourned. Thank you. Well done, Mr. Chairman. Thank you.